Okay, so we've covered the basics of Wholesaler Finances 101, your chart of accounts, your general ledger, a month-end process that you can follow, some basics on your big three financial reports, the income statement, balance sheet, and statement of cash flows. Now we want to dig in a little bit on each of those financial reports and also talk about using key financial metrics and ratios. And then I want to bring it all together with the one-page financial statement. So we'll kind of run through each of these. So to start, what I recommend for your income statement is to keep it simple, because we have a tendency to make things complicated, whether in life or in our financials. So I recommend the 5-line income statement, and this is what it can look like. So we're really just measuring the subtotals for the items on our income statement. That's sales and cost of goods, gross profit and operating expenses, and then our net income. Now, sometimes we'll add in EBITDA to the bottom here. EBITDA is earnings before interest, taxes, depreciation, and amortization. So a useful measurement for your financials. But here, we're simply grabbing our subtotals for each category, sales through net income. And what I want to do is I want to compare, I want to put a little context in my financials. So I want to see, where are we at this month? Where were we at the same month last year? And what's our goal for this particular month? So I'll kind of walk through that again. Here in the middle, what I'm measuring is the trend for a given month. So let's just say we're in October. And where are we at so far? This could even be the completed month. But I want to know throughout the month, where are we trending in sales? Where are we trending in our gross profit and so forth? And then I want to compare it to, what did we actually do the same month last year? So I'll put it in context. So where have we been? Where are we at right now? And then our goal, our budget, where do we need to be? So we can compare, where are we at on sales? Where were we last year? And what's our goal for this particular month? So the goal here is simplicity. 5-line income statement can help you with that. Now your balance sheet, what I find is a lot of folks just simply don't run and read them out. Well, what's on there? What would I find here that I need? So I want to kind of walk through a few reasons you might want to run this report and what you might want to look for. First and most basic is it's going to show us the change. If you run a comparative balance sheet, it's going to show us the change in your assets, liabilities, and equity for a period of time. Now you can do this a month-over-month change. You can do it as a year-to-date change. So you might say January 1st through the current month, what's happened with all of our assets and liabilities. So this will indicate, like, all right, cash, for example, has gone down. All right, so that might prompt some questions. All right, is it going to continue to go down? Why is it going down? Accounts receivable, in this example, is going up. Why is it going up? Do we have a collection issue? Do we need to look at, digging in on that? Inventory also is going up and so forth. So you can kind of run through, and the change in and of itself is not going to necessarily answer any questions, but it's going to prompt you to dig in a little further and ask some questions here. Accounts payable is going up. Are we paying our bills on time? What might be going on there? Loan payable is going down. We would assume that it would be if we're paying each month. So the balance sheet can give you some good indications on items that are going to affect cash flow, such as accounts receivable, inventory, and accounts payable, which we'll talk about a little bit more later. But the balance sheet should be really part of your monthly reports that we run, and you give it an eyeball and you look at the change, and that might prompt some questions for you. Statement of cash flows, it's got the best name, but it's really the one that is probably used the least amount, and I think largely because it's just hard to understand. It's like, what are we looking at here? So these can be run in different ways. Very often, I don't see businesses running these on a monthly basis. They're typically done by the CPAs at year end when you produce some formal financials, and honestly, I'm not sure how many people actually read these, but there's some good information in here. So there's different ways that you may see a statement of cash flows presented. So I tend to cut right to the bottom and say, all right, at its most basic level, what's our cash position, and did it go up or down? So at the beginning of the year and the end of the year, I want to know, did it increase or decrease? And then next, for that increase or decrease, where did it come from? So what this is showing us is different buckets of cash flow activities, and we tend to describe them as operating activities, investing activities, and financing activities, which isn't the most useful description, but that's what we've got to work with right now. So we'd start with what our net income might be, and then we're going to make certain adjustments based on changes in these balance sheet items. So you can see an increase in accounts receivable and inventory and accounts payable is going to have this effect on cash flow. Cash flows from investing activities make a little more sense. The purchase of assets. All right, so we bought some fixed assets. We spent $100,000 on it. That makes sense. Cash flows from financing. We paid down some loans, so $75,000 there. So some of these are kind of intuitive and make sense and can be useful, but others might be a little confusing. Like, well, I don't know why, we're adding back the inventory or the pay. So this gets a little murky for people. So what I recommend is creating a more useful statement of cash flows. Now, this is a 8-week snapshot. It's a template that you can use if you find it helpful. Where all we're doing is saying, what do we have for cash on hand? What do we have for a line of credit if we have one? And let's project cash out and cash in over these 8 weeks. Now you can do it over a full year, any period of time. I like 8 weeks because it's just kind of enough time to give you some visibility of what's coming over the next 2 months. And it's somewhat easier to predict. It's once you get past 8 weeks, I find it hard to predict exactly what your cash is going to look like. But we do have some consistency. Like if you look at your accounts payable, you might have some consistency in week over week what we're paying out. If you've got rent, that's pretty consistent. Loan payment is as well. So you can just take each piece and do your best to project, and then at the end of each week you can look back and say, well, how did we do on our estimate? So what this does too is it also helps make sort of the cash flow management part of the day-to-day. So again, a report you can check out, try, see if it's useful for you. So that's a little more in your big 3 financial statements, the income statement, balance sheet, and cash flows. Now we want to talk about using key metrics, financial shorthand. So here is an example of a 5-line income statement, sales through net income, and how you might just simply put in some key metrics here to help support these numbers. So if we're looking at gross profit, for example, we do it as a percentage of sales. We want to compare that to our plan. This is very easy to communicate. Our gross profit goal is 28%. For the month, we're at 25%. So easy to see if we're falling short or not. You can also throw other key metrics on your income statement. Again, you might want to measure EBITDA. Payroll is generally a huge expense, so it might be useful to call that out and say, what is it as a percentage of sales and what's our plan? Lease expense might be a large item too. So again, it's taking that concept of a simple income statement, layering in a couple of key metrics. Another way to look at or use these key metrics is to present the information from your typical income statement on a case equivalent basis. So in this example, we might want to look at our different product lines. So we've got, maybe if we have beer, wine, and non-alcohol, we might want to look at it and say, what are the sales per CE for each category? What's the EBITDA per CE for each category? Now, this is going to take some doing on your operating expenses. So how do we, go through and identify what expenses are related to beer, what's related to wine? You may need some estimates and whatnot, but this can be useful, at least at a minimum, to see what your sales per CE and your gross profit per CE might look like. You might have some surprises in there that's going to help you, make different decisions in terms of how you run your business. I want to wrap up this section with a 1-page financial statement. This does tend to be a bit of an eye chart, particularly on a video or a presentation. When you get it in a spreadsheet, it's a little more manageable, so I'd encourage you to stick with me on this. The goal here is really to pull everything together that you want to see on one page. Now here again, we've got our sales through EBITDA, and we've got some percentages on gross profit. And what we're doing is we're looking at the current year, prior year, and then we're doing some comparative work to our budget. So the idea is, on one page, I really want to know, how are we doing month to date and year to date? How does that compare to the prior year? And how are our trends looking in terms of our variances and whatnot? So I can quickly look and see, month to date, in sales, we're about 5% short of budget. So obviously that's going to give us some indication we're falling short there. Gross profit, same thing. So you can see it in percentages, you can see it in dollars, you can dig in We'll have our EBITDA down at the bottom. So the goal, again, pull all of your relevant information onto one page so you can understand where you stand month to date, year to date, relative to budget, and relative to trends for the prior month and the prior year.